Hello and welcome to this beginner's guide to fundamentals of investing. You are watching Nomad Being, and in this video, we'll be breaking down the basics of investing step by step. Whether you're new to investing or just looking to refresh your knowledge, this video is for you. So let's get started.
1. Setting financial goals. Setting financial goals is an important first step in the investing process. By having clear goals in mind, you can better determine the right mix of investments for your needs and create a plan to help you reach those goals. Some common financial goals might include saving for retirement, building an emergency fund, saving for a down payment on a home, or saving for a child's education. It's a good idea to be specific when setting financial goals and to consider factors such as your current financial situation, your age, and your risk tolerance. For example, if you're young and have a long time horizon, you may be more comfortable taking on more risk in your investments, as you'll have more time to ride out market ups and downs. On the other hand, if you're nearing retirement and have less time to recoup any potential losses, you may want to be more conservative in your investment choices. By setting financial goals and creating a plan to reach them, you can take an active role in managing your financial future and work towards the life you want. 2. Building an emergency fund. An emergency fund is a liquid, easily accessible account that you can use to cover unexpected expenses, such as a car repair or a medical bill. It's a good idea to have at least a few months' worth of living expenses set aside in an emergency fund, as this can help you avoid having to sell investments at inopportune times or take on high-interest debt in the event of an emergency. There are several strategies you can use to build an emergency fund. 1. Set aside a small amount of money each month. One way to build an emergency fund is to set aside a small amount of money each month, such as $50 or $100. Over time, this can add up to a substantial amount of money that you can tap into in case of an emergency. 2. Cut expenses. Look for areas where you can trim your budget, such as by eating out less or canceling subscription services you don't use, and use the money you save to build your emergency fund. 3. Increase your income. Consider taking on a part-time job or freelance work on the side to boost your income and build your emergency fund more quickly. By building an emergency fund, you can be prepared for the unexpected and reduce financial stress in the event of an emergency. 3. Understanding the risks. Investing always carries some level of risk, and it's important to be comfortable with the amount of risk you're taking on. There are several types of risk to consider when investing. 1. Market risk. This is the risk that the value of your investments will go down due to market fluctuations. Even investments that are considered safe, such as government bonds, carry some level of market risk. 2. Credit risk. This is the risk that a borrower will default on a loan, which can result in a loss for the lender, in this case, the investor. Credit risk is higher for investments in lower-rated bonds or bonds issued by less creditworthy companies. 3. Inflation risk. This is the risk that the purchasing power of your investments will be eroded over time due to inflation. For example, if you have a fixed income investment that pays a set amount of interest, the value of that interest may be worth less in the future due to inflation. 4. Liquidity risk. This is the risk that you won't be able to sell your investments when you need to, or that you'll have to sell them at a loss due to a lack of buyers. When evaluating the level of risk you're comfortable with, it's important to consider your financial goals and time horizon, as well as your personal risk tolerance. For example, if you're saving for retirement and have a long time horizon, you may be able to take on more risk in your investments, as you'll have more time to ride out market ups and downs. On the other hand, if you have a shorter time horizon or are saving for a specific goal, such as a down payment on a home, you may want to be more conservative in your investment choices. 4. Starting small. It's true that you don't need a lot of money to start investing. In fact, many investment options, such as mutual funds, allow you to get started with a small amount of money. Mutual funds are investment vehicles that pool together money from many different investors and use it to buy a diversified portfolio of stocks, bonds, or other securities. One of the benefits of mutual funds is that they allow you to diversify your investments without having to buy individual securities, which can be more expensive. There are many different types of mutual funds to choose from, and you can typically buy mutual fund shares for as little as $100 or $250. Some mutual fund companies even allow you to set up automatic investments, where a small amount of money is transferred from your bank account to your mutual fund account on a regular basis, such as monthly or quarterly. This can be a convenient way to build your investments over time without having to make a large upfront commitment. Other options for investing with a small amount of money include exchange-traded funds, ETFs, and robo-advisors. ETFs are similar to mutual funds in that they allow you to invest in a diversified portfolio of securities, but they are traded on stock exchanges like individual stocks. Robo-advisors are online investment platforms that use algorithms to create and manage a diversified portfolio of investments for you based on your financial goals and risk tolerance. By starting small and investing consistently over time, you can build a solid foundation for your financial future. 5. Diversifying. Diversification is a key principle of investing that involves spreading your investments across a variety of different asset classes, such as stocks, bonds, and cash. This can help manage risk by ensuring that your portfolio isn't overly reliant on any one type of investment. For example, if you invest heavily in a single stock or sector and that investment performs poorly, it could have a significant impact on your overall portfolio. On the other hand, if you diversify your investments and that same investment performs poorly, the impact on your overall portfolio may be less significant. Diversification can also improve the chances of earning a positive return over the long term. By investing in a mix of different asset classes, you can potentially benefit from the different returns that each class may provide. For example, stocks may offer the potential for higher returns over the long term, but they also carry more risk than investments such as bonds. By including both stocks and bonds in your portfolio, you can potentially balance out some of that risk. There are many different ways to diversify your investments, including investing in mutual funds or ETFs that hold a variety of different securities, or investing in a mix of different asset classes on your own. It's important to keep in mind, however, that diversification does not guarantee a profit or protect against loss. It's still important to carefully consider your investment choices and manage your overall portfolio risk. 6. Being patient. Investing is a long-term proposition, and it's important to be patient and stay the course even when the markets are volatile. It's natural to feel worried when the markets are down, but it's important to remember that market ups and downs are a normal part of investing. One way to stay focused on the long term is to set financial goals and create a plan to reach them. By having a clear sense of what you're saving and investing for, it can be easier to stay the course and avoid making impulsive decisions based on short-term market movements. It's also a good idea to review your investments regularly and make adjustments as needed, but try to avoid making changes to your portfolio based on short-term market movements. Instead, focus on your long-term goals and consider making changes to your portfolio only if your goals or financial situation have changed. By being patient and staying the course, you can increase your chances of achieving your financial goals over the long term. Thanks for watching. If you enjoyed this video, please give it a like and consider subscribing to my channel. I post new videos every week, so be sure to hit the notification bell to stay up to date. I'd love to hear from you in the comments, so please let me know what you thought of this video and what you'd like to see in the future. Thanks again for watching, and I'll see you in the next one.